welcome to the Deep Dive. We're here to slice through all that buzz and, get right to what really matters. You hear that constant hum about interest rates, right? It's not just noise. It connects directly to your daily life, your mortgage, your savings, everything. So today, we're diving deep into the Bank of England's interest rates. We're tackling the big questions. Are they too high right now? How quickly might they actually fall? And fundamentally, what does all this really mean for your money? For this deep dive, we've gathered quite a stack of sources. We've got expert analyses from the LSE Business Review, Goldman Sachs, plus practical insights from places like Investment Week, Amber River, Hargreaves Lansdown, and the Homeowners Alliance.
Yeah, and our mission today is really to cut through all that information overload. We want to pull out the key nuggets, the really important bits of knowledge from these sources, to give you a kind of shortcut, really, to understanding the expert predictions, but also, crucially, what it all means in the real world. For your finances, think of us as your, informed guide through this whole interest rate landscape.
Okay, let's get into it then. First off, what's the current temperature, economically speaking, in the UK? And where does the Bank of England actually stand with its key rate right now? That kind of sets the scene, doesn't it?
Right. So the bank rate currently stands at 4.25%. That rate's been in place since May 8th this year, 2025. That was after the bank cut it by 0.25%.
Okay, May 8th.
And interestingly, that was already the second rate cut of the year. It brought the base rate down to its lowest level since, early 2023. We saw previous cuts back in February 2025, November 2024. And the first one, the drop from 5.25%, was way back in August 2024.
Right, so a series of cuts already. And inflation, that's the bank's main target, of course. What's the latest there?
Well, that's where things get a bit tricky. UK inflation actually ticked up unexpectedly in June 2025. It went to 3.6%, up from 3.4% in May.
Oh, really? Up?
Yeah, up. And critically, it's still, quite a way above the bank's 2% target. The average for the second quarter this year came in at 3.5%, which is just a fraction above the bank's own forecast back in May, which was 3.4%.
Still sticky then. What about the wider economy? GDP, the jobs market? Yeah. What are they telling the bank? Is it a clear picture?
It's definitely a mixed bag. On the one hand, UK GDP actually contracted. It fell by 0.1% in May 2025, and forecasts vary a bit. Goldman Sachs research, for example, they're predicting UK GDP growth of about 1.2% for 2025 overall, which is actually a bit slower than the Bank of England's own projection of 1.5%.
Okay, so growth is maybe not as strong as hoped?
Yeah.
And the jobs market?
That's showing quite clear signs of cooling down. The UK unemployment rate hit 4.7% in May. That's a 4-year high.
4 years. Wow.
Yeah, up from 4.6% just in the previous rolling quarter. And wage growth is easing too. Average weekly earnings, if you exclude bonuses, fell to 5%. It was 5.3%. We're also seeing payroll numbers shrinking. There was a monthly fall of 41,000 jobs in June, and that adds up to a total contraction of about 178,000 jobs over the whole past year.
That's significant.
It is. And even job vacancies, they fell to a 3-year low, down to 727,000. So fewer jobs being advertised.
Right. So you've got inflation still stubbornly above target, but the economy seems to be slowing, and the job market is definitely cooling. It sounds like the Bank of England is in a really tough spot, a classic delicate balancing act, as they say.
It absolutely is. Governor Andrew Bailey himself has hinted at this. He suggested policymakers could maybe go for larger interest rate cuts if the jobs market really shows a pronounced slowdown. He said the bank is ready to act.
Ready to act.
Yeah. He also indicated the economy was growing sort of behind its potential, which opens up what economists call slack, spare capacity in the economy.
Right, room to grow without necessarily fueling inflation.
Exactly, and that slack can help bring inflation down over time. He sounded quite confident, saying he truly believes the path is downward for interest rates. And what's really telling, I think, is the vote at the last meeting, June 19th. The decision to hold rates at 4.25% wasn't unanimous. It was split 6-3.
3 members voted for a cut.
3 members voted for a cut. That was a stronger push for cuts than many people outside the bank expected. It really shows the debate happening internally.
That's fascinating. Okay, so understanding that economic backdrop, let's dig into the basics for a second. Why does the Bank of England raise or cut rates in the first place? And what were the main drivers behind that high inflation we all experienced?
Okay, so fundamentally, interest rates are the bank's main tool for controlling inflation. When they raise the bank rate, it makes borrowing more expensive. So mortgage payments go up, loan payments go up.
Right. Less money in people's pockets.
Precisely. People have less disposable income, so they tend to spend less. And higher rates also make saving a bit more attractive. So when overall spending in the economy slows down, businesses find it harder to raise their prices. They're less willing to.
And that brings inflation down.
That's the theory, yes. That's how it works to curb inflation. Now, as for what caused the recent surge, it really boils down to three big economic shocks hitting us. First, you had the COVID-19 pandemic. Initially, that meant shortages of products and services because of lockdowns and supply chain issues. Then, as economies reopened, there was this huge surge in demand.
Right, pent-up demand.
Exactly. Second shock, Russia's invasion of Ukraine. That sent global energy and food prices absolutely soaring. And the third factor, particularly relevant for the UK, was a shortage of workers after the pandemic. Labor supply issues. So our sources are pretty clear that the recent UK inflation was mainly cost push.
Meaning it came from rising costs, not just booming demand.
Yes, driven by those external factors like energy prices and supply problems rather than just consumer spending wildly.
Okay, that makes sense. Now let's throw another layer of complexity in here. Global trade tensions. Specifically, we hear a lot about Donald Trump's tariff policies, this sort of stop-go approach. How does that mess things up for the UK and the bank?
Ah, yes. This is a really significant external factor, and it definitely complicates the bank's job. There's some interesting research from Kostas Milas at the LSE Business Review. He uses an economic model to look at this. And his model suggests that because of the uncertainty created by Trump's trade actions, monetary policy here in the UK is actually quite tight right now.
Tighter than it perhaps should be.
That's what the model implies. It suggests the appropriate bank rate in the second quarter of 2025 should have been around 3.8%. Which is, about 50 basis points, half a percentage point lower than the actual average rate we had over that period.
So the bank might be holding rates higher than ideal, according to this model, because of that trade uncertainty.
That's the argument. The model goes further, too. It projects that a big shock from trade uncertainty could temporarily push UK inflation up, maybe by about 0.4 percentage points within a year.
Okay, a short-term rise.
But then, crucially, as that trade uncertainty hits economic growth, the model sees UK growth dropping by about 0.6 percentage points. The overall effect on inflation actually turns negative further down the line, maybe 2 years out.
So the hit to growth eventually outweighs the initial price shock.
That's the idea. The slowdown becomes the dominant factor for inflation. And the model predicts the bank might respond to that kind of shock by cutting rates quite significantly, potentially lowering them by about 1.5 percentage points, maybe 2 years from the shock. It highlights this real tension for policymakers trying to see through temporary price effects to the longer-term impact on growth.
And what about the knock-on effects? Not just the tariffs themselves, but the broader economic uncertainty these trade wars generate, filtering through here in the UK.
Right. That's what's often called the economic uncertainty channel. It's not just the direct cost of tariffs. It's the broader chilling effect that unpredictability has. When businesses aren't sure about future trade rules or, they hear speculation about potential tax rises here to fix public finances.
Or sudden policy U-turns.
Exactly, like we saw with debates around winter fuel payments or issues with Labor's proposed welfare reforms recently, or even speculation about things like a wealth tax. When all that's swirling around, businesses often just pause. They delay investment decisions. They hold off on hiring.
And that slows the whole economy down.
Precisely. It acts as a drag on growth. And it's worth pointing out, our sources suggest that it's not just external factors like Trump's policies. The current Labor government's own policy debates and announcements have also contributed significantly to this sense of domestic economic uncertainty recently.
Okay, so we've got this really complex mix. Inflation's still too high, but cooling jobs and growth, plus these significant global trade jitters and domestic uncertainty. Given all that, what are the experts actually predicting for the Bank of England's next meeting? That's August 7th, right? What's the general outlook beyond that?
Yes, August 7th is the next key date. And the consensus among analysts and what the markets are pricing in is pretty strong. The bank is widely expected to cut interest rates again, taking them down from 4.25% to 4%.
A quarter-point cut.
A quarter-point cut. Market expectations are currently putting about an 82% probability on that happening in August.
Okay, so fairly confident for August. What about further out? Into the rest of 2025 and 2026?
Well, there's a range, as you'd expect, but the general direction is definitely downwards. Most analysts seem to be penciling in 2 more cuts in 2025 after August, so maybe one in November as well. That would bring the base rate down to 3.75% by the end of this year.
Right.
Capital Economics, for instance, they also see 2 more cuts this year, August and November, hitting 3.75%, and they think there might be one more early next year in 2026, taking it to 3.50%. They even suggest there's a growing chance rates could fall as low as 3.00% next year.
3%?
Yeah.
That would feel quite different.
It would. Deutsche Bank is a bit more aggressive this year. They expect 3 more cuts, August, November, and December. That would get the base rate down to 3.5% by the end of this year. Morgan Stanley sees rates reaching 3.25% by the end of 2025, and then settling around 2.75% in the first half of 2026.
2.75%. That's quite a drop from where we are now.
It is. And Goldman Sachs research also thinks the bank will cut further than the market currently expects. They anticipate quarterly cuts running right through 2025 and into 2026 until the bank rate hits 3.25% in the second quarter of 2026.
That's quite a spread of predictions, from 3.75% down to maybe even 2.75% over the next year or so. It does make you wonder how confident these predictions can really be, doesn't it? Especially when you hear things like the OBR chair saying they might have been too optimistic about the UK economy. What could realistically derail these forecasts for rate cuts?
You're right to ask that. Confidence levels can shift quickly. We've already seen how ongoing instability, say in the Middle East, can affect things. That kind of geopolitical risk has already dampened some of the market's earlier confidence in really swift cuts. And then there's inflation itself. While it has come down a lot from the peak, the bank itself expects it to be a bit bumpy. They actually forecast a temporary rise back up to 3.7% by September this year.
What is that?
Mainly due to global energy costs and some regulated price increases, like water bills kicking in. So even though they expect it to fall back towards the 2% target eventually, this predicted bumpy path upwards in the short term. Well, it reinforces their cautious, gradual, and careful approach they keep talking about.
Makes sense. Any other spanners in the works?
Well, another thing to watch is the U.S. inflation unexpectedly rose to 2.7% in June. Some analysts are wondering if that's the Trump tariff effect starting to show up in prices over there.
Ah, interesting.
If it is, or if the U.S. Federal Reserve just gets more worried about inflation generally, they might adopt a more hawkish stance.
Meaning they might keep U.S. rates higher for longer, or even raise them.
Exactly. And if the Fed does that, it tends to strengthen the U.S. dollar. That can make other currencies, like the pound, look weaker by comparison, which can actually import inflation into the UK. It's another layer of complexity the Bank of England has to factor in.
Okay, so a complex picture indeed. Let's bring it right back home now. This is the part many people really want to know. What do these potential rate cuts actually mean for your money, your savings, your mortgage, your investments?
Right, let's break it down. For savers, it's pretty straightforward. Unfortunately, maybe not in a good way. As the bank cuts its base rate, banks and building societies almost inevitably follow suit. They'll likely reduce the interest rates they offer on savings accounts.
So cash becomes less attractive.
Essentially, yes. The returns on cash will likely diminish. It means you'll probably need to be more proactive. Shopping around for the best deals on new accounts, maybe looking at tax-efficient options like cash ISAs becomes more important. And, for building wealth over the longer term, this environment might prompt you to think about shifting some money from cash towards investments, depending on your goals and risk appetite, of course.
Okay, and mortgages. That's a big one for millions.
For mortgages, falling interest rates are generally good news. It usually means cheaper repayments. If you happen to have a tracker mortgage, which directly follows the bank rate, you'll see the benefit almost immediately.
So a 0.25% base rate cut means your mortgage rate drops by 0.25%.
Typically, yes, pretty much straight away. Now, if you're on a fixed-rate mortgage, your payments won't change during the fixed term. But the good news is that when your current deal ends and you come to remortgage, you're likely to find better, cheaper deals available than you would have otherwise.
Right, so you benefit at renewal time. What about variable rates?
For variable mortgages, like those on a lender's standard variable rate, SVR, a fall in your rate is possible, maybe even likely, but it's not guaranteed. Lenders have more discretion over their SVRs, so they might not pass on the full base rate cut, or they might delay it.
Okay, so savers see rates fall, mortgage holders mostly benefit. What about the wider property market and other investments?
Well, for the property market overall, lower mortgage rates tend to stimulate demand. If borrowing becomes cheaper, more people might look to buy, or existing homeowners might look to move. This increased demand can potentially lead to property values rising.
Makes sense.
It also makes buying a home potentially more accessible for first-time buyers, which is obviously important. And for property investors, lower borrowing costs can mean higher potential returns. It might also help developers, as their borrowing costs for funding projects could fall, potentially leading to more construction and increased housing supply down the line.
And investments generally. Stocks and shares, bonds.
For investments, particularly equity shares in companies, a base rate cut is often seen as a positive. There are a couple of reasons. Lower rates make borrowing cheaper for businesses themselves. That can encourage them to invest more in growth, expansion, new projects, which investors like to see.
Boost potential profit.
Exactly. And lower rates can also mean consumers have a bit more disposable income, perhaps from lower mortgage payments, which they might then spend. That boosts company revenues. Bond prices might also get a lift. When the base rate falls, newly issued bonds will likely offer lower interest rates, or coupons. That makes existing bonds, which were issued previously with higher coupon rates, look more attractive by comparison, so their price tends to rise.
Okay, interesting dynamics there. Finally, what about businesses directly and also people planning for retirement using annuities?
For businesses, as we touched on, lower interest rates generally mean lower operating costs, particularly if they have debt. It also makes taking out new loans cheaper, freeing up capital for investment in equipment, staff, or new ventures. Plus, the potential for increased consumer spending we mentioned can lead to higher revenues, so generally positive for business activity.
And annuities, those guaranteed retirement incomes.
For annuities, the picture is a bit nuanced. Annuity rates are linked to long-term interest rates and bond yields. While annuity incomes have actually held up pretty well recently, they could start to drift downwards if we see sustained base rate cuts filtering through.
So if you're thinking of buying one.
If you're considering buying an annuity, converting some or all of your pension pot into that guaranteed income for life, it becomes even more important to shop around carefully. Get quotes from different providers. And crucially, make sure you provide full details about your health and lifestyle. Things like smoking or existing health conditions can often qualify you for an enhanced annuity, which pays a higher income.
Right, because the provider expects to pay out for a shorter time.
Exactly. And also remember, you don't usually have to annuitize your entire pension pot all in one go. You could consider doing it in stages, perhaps securing some income now and leaving some invested, potentially allowing you to benefit from higher rates later on if they rise again, or just as you get older and annuity rates naturally increase.
Wow, okay. That was a really thorough deep dive into, well, a very complex and, as you said, sometimes counterintuitive world of UK interest rates. We've really unpacked how all these threads, global trade tensions, domestic policy shifts, inflation, jobs data, how they all weave together to shape the Bank of England's decisions, and then how those decisions ripple outwards and affect us also directly, our savings, mortgages, investments, businesses.
Absolutely. And we saw how some of those expert models are suggesting that maybe current policy is actually a bit tighter than might be optimal, given all the uncertainty, which points towards potentially significant room for rate cuts in the coming years, driven partly by things like that ongoing Trump tariff effect uncertainty. The overall path seems generally downwards, doesn't it? With many expecting that first step down to 4% happening as soon as August 7th.
Yes, and that fascinating range of predictions beyond August. Some experts seeing rates potentially falling all the way to 2.75% by mid-2026. It really highlights that while the direction might seem clearer, the actual speed and the final destination for these rate cuts, well, that remains a very delicate balancing act for the bank, navigating that bumpy path, as they put it. So after drilling down into all of that, what's a final, maybe provocative thought you want to leave our listeners mulling over?
Well, given the Bank of England has explicitly said avoiding a recession is the ogre to avoid right now, even with inflation still stubbornly above that 2% target, how much weight do you personally think the bank will ultimately place on supporting economic growth versus, sticking rigidly to hitting that 2% inflation target in the coming months? Where do you think their true priority will lie when push comes to shove on that tightrope?
Growth versus inflation. That is the core dilemma, isn't it? A lot to think about there as we look ahead to that next Bank of England decision on August 7th. Thank you for joining us on this deep dive.